We're into the new year and trading volumes have picked up. At the same time, as per our Wednesday call, we still aren't back to full form and won't be there until next week. One of the products of thinner trade can be violent moves, and that's exactly what we've seen into Thursday, with a flash crash in dollar yen during the twilight zone trading hours, shaking up the FX market in a big way. Dollar yen was trading closer to 109 when the market plunged some 5 big figures into the 104s before finally finding some demand ahead of that critical 2018 low from March at around 104.63. The fallout from the move was ugly, with Aussie crumbling through the 2016 base to its lowest levels in nearly a decade against the US dollar. Setbacks in the major currencies were less intense, though still notable, with the pound unable to avoid sinking to multi-month lows below the 2018 low that was in place around 124.80 against the US dollar, trading down to about 124.40 before finally regaining its footing, while the euro did a good job on a relative basis holding up above 113 as it benefited from its safe haven reserve currency status. The cause of the move didn't get any fat finger attribution and has instead been sourced to algos, stops, and thin liquidity at a time when we're already seeing a lot of downside risk in markets that had been pointing for things to move in this direction. In our analysis over the past few months, we've talked a lot about dollar yen rolling over since stalling out above 114 and trading back down towards and possibly through the 2018 low. If there were one specific event that could have been assigned to some of the reason behind the move, it would have been Apple's downward revision of quarterly revenue estimates and an acknowledgement that it underestimated the slowdown in emerging markets with a particular focus on China weakness. This is the type of news that should be unsettling to the global economy, as it calls into question the state of what has been a very fragile recovery since the 2008 financial markets crisis, a recovery which is a lot more exposed these days, no longer having the benefit of that same unprecedented central bank and government stimulus. We believe there is more downside ahead for risk-correlated markets, though we aren't as confident that this will be a positive for the US dollar against the major currencies, specifically the euro and pound. We've highlighted the shifting fundamentals that are decidedly less inviting of safe haven dollar demand, be it US trade policy, ongoing drama at the White House, the US government shutdown, or Fed policy likely to move even more towards a complete pause on rate hikes in 2019. This makes currencies like the euro and even the pound, especially if the UK can avoid a disorderly Brexit in the days ahead, a lot more attractive as alternative safe havens. It wouldn't be far-fetched to even suggest this latest market turmoil may actually play into Theresa May's favor, as it spooks UK Parliament into a realization that it might need to vote on a deal, as the alternative in the global backdrop could be catastrophic. While the yen will continue to try and rally as this great rotation away from risk plays out, any drops in dollar yen towards and below 100 will start to result in more aggressive intervention rhetoric out of Japan, which will likely slow the pace of dollar yen declines. Of course, there's another currency that will need watching right now, and while it's been under the radar on account of its own central bank's activity, the Swiss franc could be on the verge of taking in a lot more bids, which will only serve to upgrade the worrying status of the global economy. Euro Swiss has managed to hold up above the 2018 low for now, but a break back below the 111.80 area could trigger another big round of broad-based risk liquidation. The SNB has been one of the most active central banks when it comes to battling against currency appreciation, and the SNB is also well known for its strategies to keep the franc lower through alternative investments in U.S. equities. But we wonder how or if that model changes in a world where U.S. equities continue to fall. And so all of this leaves the euro and pound in position to benefit greatly in the months ahead. We think it will also be important to keep an eye on gold, with the yellow metal running higher despite demand for the US dollar. This is indicative of a market environment that is not wanting to hold anything but hard assets, and this could soon result in a breakout of a market that has been held down and in check throughout the post-2008 crisis period. 1375 is the 2016 high and a key level to watch. A break above could open the floodgates there. As a final note, it's worth highlighting the stability in cryptocurrencies throughout this mess. Bitcoin has been trading higher in recent sessions, and Bitcoin has even underperformed against its crypto peers during this period, a testament to legitimate renewed demand for an asset class that was absolutely decimated in 2018. That's all for now.